Welcome to another episode of the Brewing Trades Podcast, your go-to source for trading insights, tips, and strategies. I'm your host, Sam, and today we have a very special episode lined up for you. In this episode, we're diving deep into two crucial topics that can dramatically affect your trading decisions. First, we'll explore the impact of U.S. elections and political events on futures and Forex markets. How should traders adjust their strategies during such unpredictable times? What kind of risk management is essential when markets are in flux? Then, we shift our focus to seasonality, an often overlooked factor in trading strategies. Are there specific times of the year when certain assets outperform others? Maya and Remus break down how to incorporate seasonal patterns into your trading plan to improve your chances of success. As always, Maya and Remus are here to share their expert insights. So grab your coffee, settle in, and let's get into it.
Welcome back to the Deep Dive. You know we love to get into those nitty-gritty details, and today we're looking at U.S. elections.
Oh, yeah.
But not just the elections themselves.
Right.
We're talking about how they can really shake things up in the world of Forex and futures trading.
It's a fascinating topic.
It really is.
So much to unpack.
It is.
Yeah.
Because...
almost like trying to predict the weather.
Right.
But instead of rain clouds and sunshine, we've got political campaigns and then global markets.
Yes.
All swirling around.
Exactly.
Creating this kind of volatile mix.
It's unpredictable.
Absolutely.
Yeah. And we've got some really cool research and analysis
to
dig into today. So
let's jump in.
Let's jump right in.
Okay. One of the things that has always struck me about election years is this sheer uncertainty that they inject into the markets.
Yes.
It's like this giant question mark hanging over everything.
And that's what makes it so interesting, right, for us to kind of explore today.
Yeah.
And our main source today is this research paper.
Okay.
It's titled Trading Futures and Forex During U.S. Elections and Other Political Events.
Catchy title.
And they really dive into this whole idea of elections being like a volatility cocktail.
I love that phrase.
It's so good.
It's very apt.
It is.
It really captures the essence of what's going on.
Yeah.
The abstract emphasizes how this uncertainty can just lead to some wild price swings.
Oh, yeah.
Think of it like a seismograph during an earthquake.
Okay.
Those needles are going haywire.
I like that visual.
Yeah.
So, okay, we've got the U.S. dollar, which, as everyone knows, is like the world's reserve currency.
Right.
So how does it typically react during these election years?
Well, that's the thing.
Does it tend to rise or fall?
It can go either way.
Oh, really?
And that's what makes it so interesting. And also tricky if you're a trader.
Right.
The research points to some historical examples.
Okay,
like the 2008 election,
Uh-huh.
As the financial crisis was unfolding,
Right.
the USD actually took a hit.
Okay, so it went down.
Yeah, it weakened. But then in 2016, we saw a completely different story.
Okay, what happened in 2016?
Well, the dollar actually rallied after the election.
It went up.
Yeah.
Interesting.
And a lot of that had to do with market expectations.
Okay.
There's this sense that the incoming administration would be very pro-business, which tends to boost confidence in the USD.
I see.
Okay.
So if you were trading back then and you had anticipated that pro-business environment,
right,
you could have potentially made a profit by betting on the dollar to go up.
Exactly. Of course, hindsight is 2020, but that's the kind of thinking that traders have to engage in during election years.
So it's all about
it's all about anticipating those shifts in sentiment and how they might translate into price movements.
It's making me glad I'm not a professional trader.
Yeah.
It sounds stressful.
It can be, but let's get back to the research.
Okay.
The paper doesn't just look at presidential elections, right?
No.
It also explores how other political events like trade wars, surprise policy announcements, even major shifts in government can create volatility.
And for Forex and futures markets.
So when two countries get into a trade war and suddenly certain commodities become more expensive.
Exactly.
Because of tariffs and all that.
Precisely.
Yeah.
The research uses this example of U.S.-China trade tensions a few years back.
Oh, yeah.
Remember that?
I vaguely remember that being in the news.
Soybean futures.
Okay.
And even the USD-CNY exchange rate went a bit haywire.
So it's like a ripple effect.
It is.
Where political actions in one part of the world
can create these financial waves elsewhere.
Exactly.
Yeah.
It highlights how interconnected global finance and politics really are.
It's true.
You can't really separate the two.
Okay, so we've talked about how elections and political events can create volatility, but is there any way to anticipate these market movements?
Yeah.
Are there any patterns we can look at?
That's where the historical analysis comes in.
Okay.
This research takes a fascinating approach. The researchers looked at data going all the way back to 1992.
Wow.
Trying to pinpoint any recurring patterns in how currency and commodity prices behave during these crucial election years.
So they're trying to decode the past to get a glimpse into the future?
Kind of like financial time travelers.
I love it.
Yeah.
It's a good one.
They specifically focused on major currency pairs.
Okay.
Think US Euro, USD, and that sort of thing.
Got it.
And they also looked at commodities like gold and oil.
Okay.
Even S&P 500 futures, which kind of gives you a sense of overall market sentiment.
So they weren't just cherry picking certain assets.
Right.
They wanted a broad view of how different parts of the market react to those political tremors.
Exactly.
Okay.
And I think this is where it gets really interesting for our listener.
Okay. I'm on the edge of my seat.
All right.
What did they discover? Spill the beans.
One of the key findings is that volatility tends to spike in the months leading up to the election, peaking right around election day itself.
So it's not just about what happens on election day.
Right.
It's like that whole...
It's the anticipation, the uncertainty that fuels those market swings.
Okay, that makes sense.
And the research goes deeper, looking at how the USD performs depending on who wins.
Okay.
If the market thinks the new president will be good for business, policies that promote growth and stability, that sort of thing, then the dollar often rallies.
So let's say I'm like a Forex trader listening to this.
Okay.
What are some practical things I can do to navigate these election year ups and downs?
Yeah.
Because honestly, it all sounds a bit daunting.
It's definitely not for the faint of heart.
No.
But there are strategies you can use.
Okay.
The first thing the research emphasizes is risk management. Election years are inherently volatile.
Right.
So you don't want to go all in on any single trade.
Right. So don't bet the farm on who you think is going to win.
Exactly.
Okay.
Instead, consider hedging strategies. Think of it like an insurance policy for your trades.
I like that.
There are tools like option and volatility derivatives that can help you mitigate potential losses if the market takes an unexpected turn.
Okay, so options and volatility derivatives.
Yeah.
Can you break those down a bit?
Sure.
Because I have a feeling some of our listeners might not be familiar with those terms.
An option, in the simplest terms, gives you the right but not the obligation.
Okay. To buy or sell an asset at a specific price within a certain time frame.
Got it.
So if you're worried about the market going down, you might buy a put option.
Okay.
Which gives you the right to sell at a certain price.
Okay.
Limiting your potential losses.
It's like a safety net.
It is.
Okay.
In case things get really messy.
I like it.
What about these volatility derivatives?
Yeah, those sound a bit more intimidating.
They might sound complex, but they're really just financial instruments that allow you to trade on the expectation of volatility.
Okay.
So if you think volatility will increase around the election, which the research suggests is likely, you could potentially profit from that.
Using these types of derivatives,
this
is making me wish I'd paid more attention in my finance class.
Never too late to learn.
But okay, so hedging strategies, options, these volatility derivatives are tools traders can use to manage risk during election years.
Is there anything else?
Well, the research also highlights the importance of technical analysis. This is basically studying historical price patterns and trends to try and anticipate future market movements.
So kind of like reading the tea leaves of the market.
Kind of. Looking for those subtle to see what might happen next.
Okay.
It's not a foolproof method, of course.
Right.
But it can give you valuable insights.
Especially
during those volatile election years, any edge you can get is helpful.
Speaking of edges, I remember the 2020 election being particularly chaotic.
Yeah.
Did the research touch on that at all?
They actually devote a whole section to it.
Oh, really?
It's a fascinating case study.
Okay.
Because it really illustrates just how unpredictable things can get.
Okay.
Yeah.
I'm picturing myself glued to my computer screen on election night.
I can imagine.
Watching those numbers bounce around like a ping pong ball.
It was a wild ride.
Paint me a picture. What was happening in the markets?
Well, as the results were trickling in, and it was clear how close the race was, the S&P 500 futures were going absolutely crazy.
Oh, wow.
They swung wildly throughout the night as different states were called.
Wow.
Reflecting that uncertainty we talked about.
I bet there were a lot of traders hitting the refresh button on their browsers that night.
You can say that again.
So,
but here's the interesting part.
Okay.
Once the dust settled and the outcome became clear, what happened?
I'm guessing things calmed down.
More than that, the S&P 500 actually rallied.
It went up.
Yeah.
Interesting.
It was a pretty remarkable recovery after all that initial volatility.
So even in the midst of all that political drama, the market eventually found its footing.
It did.
That's almost reassuring in a way.
It is.
Isn't
it? Kind of speaks to the resilience of the markets.
Yeah.
While political events can definitely create short-term chaos, over the long run, tend to balance out.
That brings up a question I had about the U.S. dollar.
Okay.
We talked earlier about how it can either rally or weaken, depending on who wins the election.
Mm-hmm.
But what about its role as the world's primary reserve currency? Does that make it extra sensitive?
That's a question.
To political events in the U.S.?
And you're right.
Okay.
The USD's role as the global heavyweight does make it particularly sensitive to political shifts in the U.S. The research actually dives into this.
I'm all ears.
What did they find?
Well, they found that during election years, the USD can appreciate or depreciate quite significantly.
Okay.
And a lot of it comes down to market expectations about the incoming president's policies.
So it's like a giant game of political forecasting.
It is.
If the markets think the new president will be good for the U.S. economy, they flock to the dollar.
Right.
Driving up its value.
Yeah.
But if there are concerns about potential missteps, then the dollar could take a hit. Exactly.
Yeah.
And this was really evident in the examples we discussed earlier. The USD weakened during the 2008 financial crisis, but then strengthened under new leadership in 2016. It just shows you how much those political wins can influence the currency markets.
So if I'm a Forex trader, specifically focused on the USD, what are some things I should be paying attention to in these election years?
Well, first and foremost, I'd say really dig into the candidates' economic platforms.
Okay.
Are they proposing policies that are seen as pro-business? Do they favor things like fiscal stimulus? Or are they more focused on austerity measures?
Right.
These kinds of signals can give you a sense of how the dollar might react.
So it's almost like doing your political homework before you place your trades.
Precisely.
And don't forget about the Federal Reserve.
Right. The Fed, their monetary policy decisions can also have a huge impact on the dollar's value.
Especially in relation to other currencies. So it's not just about who wins the election,
right,
but also how the Fed responds to the changing political landscape.
Exactly. And of course, you always want to keep a close eye on those key economic indicators.
Like what?
Inflation, GDP growth, employment numbers. Those underlying fundamentals can either support or contradict the political narratives that are driving the market.
So it's about connecting the dots.
Yeah.
I mean, all these different factors, the economic
context,
to get a clearer picture of where the dollar might be heading.
Absolutely. And the research also points out another fascinating aspect of all this.
Okay. What's that?
The role of political stability.
Okay. Political stability, or I guess...
or the lack thereof.
Yeah. How does that play into all this?
Well, when investors perceive a high level of political risk, whether it's due to a contentious election or some other kind of political instability, they tend to demand a higher return on their investments.
To compensate for that risk.
Exactly, to compensate for that added uncertainty.
So it's almost like a risk premium gets baked into asset prices because of political instability.
Exactly. And we see this play out especially during those periods leading up to a major election.
Oh, yeah.
Remember all that volatility we talked about?
Yes.
A lot of it is driven by that heightened sense of uncertainty and risk.
So it's not just the potential policy changes that traders have to worry about.
Right.
It's also the overall level of political stability or instability that can impact their decisions.
Precisely. And that instability can have wider implications too.
Really? Like what?
Beyond just the financial markets,
okay,
it can make it more expensive for businesses to borrow money, which can slow down investment and economic growth.
So it's really a ripple effect.
It is.
Political instability creates uncertainty, which impacts risk perception, which then affects investment and the overall economy.
Like a chain reaction. It underscores just how deeply intertwined politics and economics truly are.
They really are.
Yeah.
Okay, we've covered a lot of ground here.
We have.
Volatility, historical patterns, trading strategies, even the impact of political risk.
It's a lot to digest.
It is.
But one thing that keeps coming up in the research is this emphasis on staying informed.
That's so important.
It is.
Especially in this day and age.
Absolutely.
So understanding those historical patterns is just the first step.
Right.
To truly navigate these election years.
Mm-hmm.
You need to stay on top of current events and economic forecasts.
Things are constantly changing.
Yeah.
And what worked in the past might not work in the future.
So it's not enough to just study the history books.
Right.
You need to have your finger on the pulse of what's happening right now.
Exactly. And this is where things get even more challenging, but also more exciting.
I like that.
Okay.
What I'm hearing is that in today's world, where information travels at lightning speed and geopolitical events can send instant shockwaves through the markets,
right,
traders need to be even more vigilant, more adaptable than ever before.
You hit the nail on the head. It's not enough to just follow the financial news.
Right.
You need to have a deep understanding of the political landscape, both domestically and globally. And you need to be able to connect the dots between those political events and how they might impact different asset classes, different currencies, different markets.
It's almost like you need a dual degree in political science and finance to be successful these days.
It's definitely becoming more interdisciplinary. And it's not just about the knowledge, it's also about the mindset. You have to be comfortable with uncertainty, with risk, and you have to be able to adjust your strategies on the fly as new information emerges.
So flexibility and adaptability are key.
Absolutely.
It sounds like the old saying, the only constant is change.
It's true.
Really applies to the world of trading, especially during those election years. Well, I think we've done a fantastic job of unpacking this complex topic.
I agree.
We've explored how U.S. elections create volatility, dug into those fascinating historical patterns, and even learned some practical tips for traders.
Absolutely.
But before we wrap up this deep dive, I want to circle back to something you mentioned earlier about how the USD can see a significant rally.
Right.
If the election outcome is seen as favorable to economic growth.
That's a key takeaway.
Yeah.
It really highlights how much faith the market puts in the perceived competence of the newly elected leadership.
Right.
If there's a sense that the new administration will be good for business, will create stability, then we often see a surge in demand for the USD.
So it's almost like a vote of confidence.
It is.
In the future direction of the U.S. economy.
Exactly.
But on the flip side, if there are concerns about the new president's policies, or if there's a perceived risk of instability, then the dollar could weaken.
It's like the market is saying, we're not so sure about this.
And that's why it's so crucial for traders to not only understand the candidates and their platforms, but also the broader economic and political context. You have to look at everything.
Everything.
From interest rates and inflation to geopolitical events and global trade dynamics.
Absolutely.
To really get a sense of where the dollar might be heading.
It's a complex puzzle.
It is.
But it's a fascinating one to try and solve.
So it's not just about who wins the election. It's about the entire ecosystem in which that election takes place.
Precisely. And that ecosystem is incredibly complex and dynamic.
Yeah.
Which is what makes trading during these periods so challenging, but also so potentially rewarding if you can navigate it effectively.
Well, on that note of both challenge and reward, I think it's time to wrap up this episode of The Deep Dive.
It's been a pleasure diving deep into this fascinating topic with you.
And to our listeners, we hope you've gained some valuable insights into the wild world of Forex and futures trading.
During U.S. elections.
Remember, staying informed is key.
Absolutely.
Keep learning.
Keep exploring.
Keep exploring. And as always, keep diving deep.
Until next time.
Until next time. Happy trading. Welcome back, listeners. Ready for another deep dive. Today, we're going to unlock a secret weapon in the world of finance, and that is seasonality. These are those predictable patterns in asset prices that pop up at certain times of year. And, you've been digging into this, especially in futures and Forex markets. So let's dive in and unearth the coolest bits. We're talking about why heating your home makes crude oil spike in the winter, if there's truth to the January effect in stocks, and how spotting these patterns could actually, be profitable.
What I find so captivating about seasonality is that it's not just some random market quirk. It's rooted in real world things like weather, harvests, and even how those big institutions manage their money. So understanding this really adds a whole new dimension to how we view the markets, right?
Okay, so before we get into specifics, let's make sure we're all on the same page about futures. Can you help us break down what a futures contract actually is?
Sure. Think of it like this. You and I agree today on a price for something, let's say a barrel of oil, that will exchange at a specific date in the future. So that's a futures contract, basically. It's all about locking in a price today for a transaction that'll happen later.
So why should someone care about seasonality when it comes to these futures contracts?
Well, because knowing the typical seasonal trends for, say, oil or wheat can really give you an idea of whether that future price is a good deal or not. Imagine locking in a price for heating oil in July when it's typically cheap versus doing it in December when everybody needs it. That's the kind of edge seasonality can offer.
That makes a lot of sense. Now, you mentioned some research that really caught your eye, especially since it dives deep into a whole decade of data.
Yeah.
Tell me more about that.
It's a fascinating academic study that doesn't just rely on theories, It crunched actual price data from major exchanges like the CME Group and ICE, and over a 10-year period. And they, by applying some serious statistical analysis, they managed to pinpoint the most statistically significant seasonal trends. And this isn't just some niche stuff. They looked at a wide range of markets.
This is where it gets really exciting. Let's jump into those juicy examples, starting with something we can all relate to, food, specifically agricultural commodities like corn and soybeans. Those must have some serious seasonal swings, right?
Oh, absolutely. Think about it. These crops have very specific planting and harvesting times, and those cycles drive some amazingly predictable price movements. Take corn and soybeans. Between April and July, when planting is in full swing and demand is high, prices tend to climb pretty steadily.
So it's like clockwork. But for crops...
Exactly. And it doesn't stop there. Wheat, for example, has its own unique seasonal pattern. It typically peaks in late summer, not just because of harvest, but because that's when weather risks are highest, potentially impacting the yield, driving up prices. It all comes back to those real-world factors we talked about earlier.
It's amazing how something as simple as the weather can have such a huge ripple effect on global markets. Speaking of weather, let's move on to energy commodities, where things heat up. Literally, you've probably noticed it yourself, your heating bills tend to be higher in the winter. Well, that's no coincidence. Crude oil prices often climb between October and February because demand for heating oil soars, pushing up the price of the crude it's made from, so it's like a chain reaction. Colder weather, more demand for heating oil equals higher crude oil prices. I bet natural gas follows a similar pattern.
You got it. Natural gas usually sees a big price spike between November and March, driven primarily by heating needs across the Northern Hemisphere. It's like a textbook example of seasonality driven by weather patterns.
Okay, so we've seen how weather impacts agricultural and energy commodities. But what about the stock market? Is there any kind of seasonal rhythm there?
You bet. The research shows that the S&P 500 and NASDAQ futures often gain strength between November and April. It's a period that includes the holiday season, when consumer spending usually increases, and the start of a new year, which can bring a wave of optimism, right, to the market.
Wait a minute, are you talking about the famous January effect? That thing where stocks supposedly surge in January? Is that real?
It's a hotly debated theory, but there's some evidence to back it up. Some analysts believe it's partly due to big institutions doing what's called portfolio rebalancing at the end of the year. They sell off losing investments in December to offset gains and minimize their taxes. Then, come January, they're flush with cash and ready to reinvest, potentially driving up stock prices.
So it's not just about holiday cheer. There's some serious financial strategy behind it.
Exactly. And it really highlights how understanding the behavior of these institutional players can give you valuable insights into seasonal market movements.
This is all so fascinating. We've covered a lot of ground, from crops to oil to stocks, and it's clear that seasonality is everywhere. But before we get too carried away, let's shift gears to a different kind of market, the world of currencies, where things are constantly in flux. How does seasonality play out in the Forex market?
Forex is a whole other beast, but seasonality definitely exists there too. However, instead of weather or harvest cycles, it's often driven by things like economic data releases, central bank decisions, and, you guessed it, the behavior of those big institutions.
Okay, I'm hooked. Tell me more about how seasonality affects specific currency pairs. Like, what about the euro versus the US dollar? What kind of patterns do we see there?
Well, the euro and the US dollar, or UUSD as it's known in the trading world, is a fascinating example of how seasonality can play out in Forex. The euro tends to weaken in the first quarter of the year.
Why is that? Does it have anything to do with New Year's resolutions to spend less? Kidding, of course. What's the real reason?
Well, it's not about personal spending habits, but it does relate to how institutions manage their finances. Many European companies and organizations have a fiscal year that ends in December. So as they approach this deadline, they often need to adjust their currency holdings, perhaps repatriating profits or meeting reporting requirements. And these large-scale transactions can put downward pressure on the euro, contributing to its seasonal weakness in the first quarter.
So it's like a ripple effect from all those year-end financial activities. Makes sense. But you said the euro tends to weaken in the first quarter. Does it bounce back later in the year?
Yes, quite often it does. The euro often sees a period of strength during the summer months. This might be linked to increased demand for European exports during the tourist season when more people are traveling and spending money abroad.
So it's almost like the euro has its own mini cycle within the year, weakening in the first quarter, then strengthening in the summer.
That's a great way to put it. And this pattern can be valuable information for Forex traders looking to capitalize on those seasonal swings.
I can see how understanding these patterns could be a real game changer for traders. It's like having a sneak peek at the market's playbook. But are there other currency pairs that show these kinds of seasonal tendencies?
Absolutely. The USD-JPY, which represents the US dollar against the Japanese yen, is another interesting one. It tends to strengthen between August and October.
Now that's a bit surprising. I wouldn't have guessed there was a specific time of year when the dollar tends to rise against the yen. What's driving that pattern?
There are a couple of potential explanations. One is related to Japan's fiscal year, which, unlike many other countries, ends in March. As Japanese companies and institutions approach their fiscal year end, they often engage in rebalancing activities that can impact currency flows, potentially leading to an inflow of capital into the US dollar and a strengthening of the USD-JPY pair.
So it's similar to what we saw with the euro and its fiscal year-end activities, but on a different timeline.
Precisely. And it highlights how important it is to understand the specific financial calendars and practices of different countries when analyzing Forex markets. It's not just about global trends. Local factors can have a huge impact. Okay,
we've covered the Euro-USD and the USD-JPSD. What about the GBP-USD, the British pound against the US dollar? I always hear about how volatile that pair is. Does seasonality play a role there too?
Definitely. The GBP-USD, also known as cable in trading lingo, can get especially wild in the spring and fall. And it's not just random volatility. It's often tied to key events in the UK's economic and political calendar.
Ooh, like what? Spill the tea. What kind of events are we talking about?
Well, think about the UK budget, which is typically announced in the spring. That always has the potential to shake things up in the currency market. Traders are eager to see what the government's spending plans are and how they might impact the economy. And that anticipation can lead to big price swings in the GBP-USD.
So it's like everyone holding their breath, waiting to see which way the wind will blow, and then bam, the budget drops and the market goes crazy.
That's a great way to visualize it. And it's not just the budget. Announcements from the Bank of England, like interest rate decisions or updates on their monetary policy, can also trigger major volatility in the GBP-USD, especially if they come as a surprise to the market.
It's like everyone's playing a game of chess, trying to anticipate the next move. But in this game, the pieces are currencies and the stakes are high. This makes me realize just how interconnected everything is. It's not just about looking at charts and patterns. You have to understand the bigger picture of what's happening in the world, in politics, in economies.
Absolutely. Seasonality is a powerful tool, but it's not a crystal ball. It's essential to combine it with other forms of analysis, fundamental, technical, and definitely keeping an eye on those global events that can throw a wrench in even the most predictable patterns.
All right, we've explored how seasonality impacts futures and Forex. But before we wrap up, let's circle back to something you mentioned earlier, gold. You said it has some interesting seasonal tendencies too. Can you elaborate on that?
Gold, often seen as a safe haven asset, is fascinating because its price tends to be stronger in the latter half of the year, particularly between August and January.
Why is that? Is it because people are buying more gold jewelry for the holidays?
That's part of it. The Indian wedding season, which falls between October and December, plays a significant role. Gold is a traditional gift in India, and this surge in demand often drives up prices globally. But it's not just India. Festivals and holidays in other parts of the world, like Christmas and Chinese New Year, also contribute to increased gold demand during this period.
Wow, so cultural traditions can actually move global markets. That's incredible. I never would have guessed that weddings in India could impact the price of gold all over the world.
It's a great example of how seemingly unrelated events can have ripple effects in the financial markets. And it underscores why understanding global trends and cultural influences is so important for anyone interested in trading or investing in gold.
Okay, so we've seen how seasonality impacts futures, Forex, and even gold. But how can our listeners actually use this knowledge to their advantage? It can feel a bit overwhelming, especially for someone new to this concept.
You're absolutely right. It's important to start simple and focus on the markets you're most interested in. The first step is to research the historical seasonal patterns of those assets. Thankfully, many trading platforms offer tools and charts that can help you visualize these trends.
It's about doing your homework and getting familiar with the historical tendencies of the assets you want to trade or invest in.
Exactly. Once you have a basic understanding of the seasonal patterns, you can start incorporating this knowledge into your analysis. Look for confluence, where seasonal tendencies align with other indicators, like technical signals or fundamental news.
So it's not just about blindly following the calendar. It's about integrating seasonality into a more comprehensive trading strategy.
Precisely. It's like having another piece of the puzzle, helping you make more informed decisions.
But even with all this knowledge, there are always risks involved, right? You can't just assume that because something happened in the past, it's guaranteed to happen again.
That's a crucial point. No matter how promising a seasonal pattern might appear, it's essential to have a well-defined risk management plan in place. This includes setting stop-loss orders to limit potential losses and never risking more capital than you can afford to lose.
So it's about being smart and not letting those seasonal trends lure you into making reckless decisions.
Exactly. Risk management is paramount in trading, regardless of whether you're incorporating seasonality or any other strategy. It's about protecting yourself and ensuring that you can stay in the game for the long haul.
This has been an incredible journey into the world of seasonality. We've uncovered how natural cycles, economic events, and even human behavior can create these fascinating patterns in the markets. But before we wrap up this episode, I want to leave our listeners with one final thought. Seasonality is not about predicting the future with certainty. It's about recognizing that history often repeats itself, and that understanding these patterns can give us a valuable edge in navigating the financial markets.
It's been a fascinating journey, revealing how these recurring patterns, often driven by forces beyond our control, can shape market trends and create opportunities for those who understand them.
So, dear listeners, keep exploring, keep learning, and keep those minds open to new possibilities. The world of finance is full of fascinating patterns and insights waiting to be discovered.
And who knows, maybe you'll uncover the next great seasonal trading strategy. Until next time, happy trading, and may the odds be ever in your favor.
We've journeyed through the world of futures and Forex, even delved into the glittering realm of gold, all through the lens of seasonality. But let's bring this home for our listeners. How can they actually put this knowledge into action? It's one thing to spot a pattern, but another to actually use it wisely.
Yeah, that's where the rubber meets the road, right? The key is to start small, focus on the markets that genuinely interest you, and then do your research. Don't try to conquer every asset class at once. Pick one or two that you're drawn to, and then dig into their historical seasonal patterns.
So it's like becoming a detective for your chosen market, looking for clues in the past to help solve the mystery of future price movements.
Exactly. And thankfully, we're not stuck with dusty old ledgers and magnifying glasses anymore. Many trading platforms have fantastic tools and charts that let you visualize these seasonal trends with ease. It's like having a time machine for your market research.
Okay, so let's say I pick my market, I've done my research, and I've spotted some intriguing seasonal patterns. What's the next step? Do I just jump in and start trading based on the calendar?
And hold your horses. Remember, seasonality is just one piece of the puzzle. It's crucial to combine it with other forms of analysis, technical indicators, fundamental news, and your own assessment of the overall market sentiment. Look for what we call confluence, where multiple indicators are pointing in the same direction.
So it's like gathering evidence before making a case. You wouldn't convict someone based on a single fingerprint? Right. You need multiple pieces of evidence to build a strong argument.
That's a great analogy. Seasonality can be that crucial fingerprint, but you need other evidence to corroborate it. For example, if you see a seasonal pattern suggesting that crude oil prices tend to rise in winter, you might wait for a technical indicator, like a breakout above a key resistance level, before entering a trade.
So it's about patience and waiting for the right moment to strike. Not just blindly following the calendar, but being strategic and selective about when to act.
Exactly. And even when everything seems to be lining up perfectly, it's vital to remember that risk management is paramount. No matter how confident you are in a trade, always have a plan in place to protect your capital.
This brings us back to that crucial point. No matter how much we learn, there's always an element of uncertainty in the markets. Seasonality can tilt the odds in our favor, but it's not a foolproof system.
That's right. The markets are complex, ever-evolving beasts, right? New information emerges constantly, unexpected events occur, sentiment can shift on a dime. So while seasonality can be a powerful tool, it's essential to approach it with a healthy dose of caution and a rock-solid risk management strategy.
This has been an incredible deep dive into the world of seasonality. We've explored its underlying causes, its influence across various asset classes, and most importantly, how our listener can use this knowledge to potentially make more informed financial decisions.
It's been a fascinating journey, revealing how these recurring patterns, often driven by forces beyond our control, can shape market trends and create opportunities for those who understand them.
Absolutely, and as we wrap up, I want to leave our listeners with one final thought. Seasonality is not about predicting the future with absolute certainty. It's about recognizing that history often rhymes, and that understanding these rhythms can give us a valuable edge in navigating the complex world of finance.
It's about adding another layer of insight to our analysis, another tool in our arsenal as we strive to make sense of the markets and make smarter decisions.
So to our listeners out there, keep exploring, keep learning, and keep those minds open to new possibilities. The world of finance is full of fascinating patterns and insights just waiting to be discovered.
Until next time, happy trading, and may the odds be ever in your favor.
That wraps up today's episode of the Brewing Trades podcast. We hope our discussion on trading during U.S. elections and understanding seasonality in futures and forex markets has given you fresh perspectives and actionable insights. A huge thank you to Maya and Reeks for sharing their expertise, and as always, to you, our listeners, tuning in. If you enjoyed the episode, don't forget to subscribe and leave us a review. Your feedback helps us bring more valuable content to the trading community. Be sure to join us next week as we dive into more strategies and analysis on the Brewing Trades podcast. Until then, trade smart, trade informed, and as always, keep brewing those trades.